Hello, everyone. It's been a quiet week on the Twitter front. I was just going through my tweets. That's my best efforts, believe you me. I mean, put a lot of emphasis and work on my tweets, reading, researching, um, listening to great podcasts like the one from with Moritz and Richard, which I don't think I'd ever heard before. Um, but somehow, November 2022, that got by me. And so I enjoyed that on the treadmill yesterday. um, some of the tweets I post out there, they're like the least loved and liked. And they're like my favorites. I forgot which one it was, but today I noticed I had 4 likes. Yeah, 4 likes. That's pretty bad. On something I really thought was a huge winner. So I wanted to talk about the markets a bit. I think it's a good idea to stay focused on trend trading the markets and what's going on. And this week, we talked on Twitter a bit about some of the corn and soybeans being so volatile, long to flat to short to long again, and corn in particular, kind of crazy. Soybeans are probably going to be a loser as well. Probably looks similar to corn. I held in there with all of my wheats though, and gold kind of stinks. Nothing going on there. But I think for me, it was kind of fun to watch the the interest rates crash and crater. And I guess in my mind, I've called those trades over the past few months, maybe not outliers, well, maybe there's a few big outliers, but, obviously those trades were not over and they chopped around for a while and loose pants kept you in. I didn't get knocked out of hardly any, just a couple, maybe just a couple of systems of one or two markets. And actually did go long-term BTPs last week, which is going to be a loser probably. But yeah, you have those loose pants, and then your system itself is dictating a lot about that outlier. Is it an outlier? How big of an outlier? Yeah, so looser pants, the outliers can be smaller. And then, as I've said before, you have you lose pants. You keep these trades on. They don't do anything for months and months. They have these vicious rally in March, whenever everyone knew that trade's over. And then the really adept CTAs massaged that, managed that, and got out and vol managed and correlation managed, and they avoided all of that. A lot of the March they really didn't, but that's what they're attempting to do. And then of course all for naught because now they got to get short again and new ATRs where we can hold our ATRs that were like 2 years old. These microscopic ATRs, we put them on. It's almost embarrassing and scary to put on these big positions when the ATRs were so small and compressed. And then we just sit with it for a couple of years and stay in the trade. And then when it makes new lows and starts resuming the trend again, we still have on the same positions, and it's just making a fortune, making a killing. And that's that whole benefit of looking at things on a trade by trade basis and sizing it and treating the winners much different than you treat the losers. So that's classic trend following in a nutshell. And then Richard and Moritz were kind of talking about things like that as well, and I couldn't help but think about that. I love that chart that Richard had, which overlaid the non-normal distribution of trend following trades over top of a normal distribution. That was pretty interesting. I don't know if I'd seen that or paid much attention to when other people had done that, if they did it over the years. But that was really a good way of being able to see the difference, and then a big spike in the middle where most of the trades are small losers, small winners. But that trend following system, your trend following system, that's creating that distribution, that favorable distribution. and then focusing in on that middle and seeing Richard kind of explain how. I guess I must be a very visual learner because seeing him kind of explain something he's mentioned a million times, this idea of the convergent people, um, that's where they are. That's what they're trying to focus on with the mean reversion, maybe even vol management. And I guess the problem with that is they don't know any more than we do when those tails are going to occur. And so they think they're in this region, but you may be leaving that region for another region. So I thought that was very interesting. It's always good to see those two talking about trend following and and reemphasizing and confirming all the things we talk about here with a little bit more in depth. They're very good at getting deep into how it all works. Let's see what else I wanted to mention. Yoga, it's pretty cool. You can charge an extra 75 bips if you're a really famous hedge fund because you have to recruit really smart quants. But part of that goes to the yoga classes as well. I thought that was, well, it's pretty interesting. I don't think I would do a yoga class. Obviously, I'm on the treadmill and I don't need a trainer for that. My weightlifting, I'm an old man, but I still lift weights. Makes me feel good about myself. Don't really think I need a trainer for that. My wife does yoga, Kathy Woods, but not going to get 75 bips extra for that. I'm not. No, not at all. I was on the Covell podcast. I got some questions about Covell and that podcast. It was really fun being on with him. He let me talk about the ETF quite a bit. Got delayed until Tuesday. Hopefully Tuesday. I'm ready. I got my part is covered, but we'll see if my partners are ready to go. Okay, here's one I wanted to bring up. This was an interview from a new CTA. I mean, I think these guys are very experienced, and I think they're new. This was an interesting quote, and this is something we've talked about, but it goes like this. The trend following strategy is designed to provide portfolio diversification and alpha generation. The strategy's investment universe consists of 21 markets, which have been carefully selected to achieve maximum diversification with minimum correlation. So that's really getting to what Richard and Moritz talked about on the podcast, which was we don't really focus on that too much. We don't want to achieve this maximum diversification, minimum correlation. We'd never trade just 21 markets. I mean, I traded 21 markets in 1984, and I have always looked back on that as how horrible was that? I mean, how bad was that? You only had 20 some markets. Now 300 some markets. So more focused on small bet sizes and finding those outliers that reside in the same sector, the same correlated sector, crude, heating oil, unleaded, um, and corn, wheat, beans, meal, oil, rapeseed, canola. That can happen. And so not trying to use a back test to maximize the diversification, get it down to 20 some markets, and focus on how incrementally adding markets is of less and less value, but not if you're hunting outliers. All right. It was a long, long monologue. Morning, Oleg.
Hi Jerry, hi Maritz, hi Brian, hi Richard, hi all the guys I see here, and Seth, Dingle. So I always say that I'm very happy to see you, and I will say it. I think every time I'm hoping for many decades, because really I'm delightful to be here. Alp, I see Alp here, and also I'm very happy to see Alp also. So it was a nice week because I'm a trend follower, and every week is nice for me because I have my philosophy, I have my traits, I have my math and my backtest. I have these wonderful podcasts with Jerry, with Niels, with Richard, with Maritz, and I listen it almost every day. And I still, for a few years, I'm still doing my notes almost every day. And some of them I publish. And this week I was listening to a very wonderful podcast with Michael Cavell and Jerry, and it was very insightful. Yes, and I listened conversations with Jerry, and it's a miracle, but I think almost every conversation is insightful for me. Every conversation, because of course I know our philosophy. I every day I think about our philosophy, about our trading strategy, and it's so deep. And really, Richard Brennan also he's for me personally a great discoverer of great scientist of our trend following strategy. And like Jerry said, that because of Richard also we understand how deep it is. Yes, and I always say that when I look at the nature, when I look at it, even at weather charts, I think that our trend following approach is great. And if we talked about convergent strategies today, and I want to say that I think that, and I remember Jerry said such similar for that convergent strategies is not the best approach for our dynamic world. The world is dynamic thing structure, and the market also is a part of our world, and it's also dynamic. So, convergent strategies sooner or later will face a lot of problems. So, of course, it's not the best solution, I think. So, let's get started. And I'm really very happy. And our previous conversation, I faced less program issues, and I had very nice mood for all week because of that, really. And I'm hoping that this conversation I will face not much technical issues, and will make me happy also. Okay, let's get started.
G'day, Oleg. G'day, Jerry. Hi, everyone. Great to be here. Yes, Jerry, congratulations on your Covell podcast. So is there another one coming?
Is there another one coming? I don't remember. I think I'm going to be on Top Traders Unplugged as part of a CTA series. They're going to ask me those same questions. I think I don't have a date. That'd be fun and nice. I have listened to all those things more than once. It's a fantastic job. I mean, I think it rivals um, Market Wizards, honestly. For me, I've been touting Market Wizards, those two books, ever since I read the first two, and I thought they were amazing. The other ones, not as much, but I think they were fantastic. Is trader interviews, a little bit like Trader Spaces and Trader Podcasts. You just can't beat them. And I've listened to those Top Traders Unplugged CTA things with Niels and Alan, and so I'm ready. I'm going to get more ready if I get a date and I'm able to go in there. But they're ready for me too. They're going to try to beat me up with the classic because I'll be the only classic one in there. I'm pretty sure. And then hopefully later I can go on and just do the marketing of the of the ETF. I'm ready for that one as well. I've got lots of notes and comments about why I'm doing this. I'm going to get questions like even people on Twitter ask me, why the hell are you doing this at such a low fee and transparency? So I've got to have some good answers for why we're even doing it. And I think Niels will be hammering on me on that as well, as he should. I need to have some good answers. But most of these podcasts, you just come up pretty quickly. Um, so I don't have anything on the books yet.
Yes, it's I love those miniseries. Yeah, I tend to get a bit more out of them than I do out of the Jack Swagger series because it's asking the same consistent questions to different trend following programs. And I like the way they've done it because it really sort of it really tells you a story about the different nuances that a lot of these trend following programs have. So, over I think we've had about, 12 or 13 or however many we've had so far. It shows what a diverse group the trend following community are. Whilst, you know, a, there are these general principles that you could probably say most agree with. Gosh, there's a lot of variation in it. And I noticed that also in their distribution of returns, I like the way they're sort of getting under the hood, looking at the particular processes that are being applied by the different trend following mob. It's interesting. I also had a listen to a recent Covell podcast where he had his monologue, and I think he had an interesting European hedge fund manager talking about the days of the Turtles and then the Europeans coming in about the 90s with AHL and then the spin-offs with Harding and all of those things. And, there was a couple of contentious things that were said there in that he was referring to the old style of trend following as using consistent lot sizing for the different markets. Now, I've never known that to be the case. I know that there's a consistent dollar risk applied to each market so that each of the bet sizes are equal in terms of dollar risk, but I don't necessarily think it's a mere consistent lot application to each market. And he was saying how strange that was because in their more quantity style world with where they relied more heavily on statistics, those traditional ways were sort of looked at quite spuriously in that, how could you have equivalent bets when you're dealing with consistent lots amongst the different markets? But I don't necessarily think that's ever been the case. What do you think, Jerry?
Right. I think, yeah, they did come over. They did come over with new ideas and new ways of doing things, and they did make a splash, and it continues today because they have the vast majority of AUM. You could include Graham in there. They're pretty big. I know I'm forgetting another U.S. No one. You should probably include Bridgewater, but definitely Graham and Dunn. Oh yeah, Dunn. They're still definitely holding their own major player in managed futures. The problem with coming over with and doing things differently, they weren't doing it better. Uh, so yeah, that's kind of probably a problem they should address. Why at least if you're going to come over and take all the money, you should at least do something better. And they really weren't able to do that, and they don't. They're never going to do it because they're never going to back off the managed futures. Dynamic position sizing and vol management, correlation management, and all the extra features that they watered down on the trend following. And then one of the guys on the series said that they did a test. One of the really smart firms, uh, CF, CFM or something like that. They said, and I posted this as my pinned tweet for many months, that when we looked at all the performance of the SocGen index, SocGen CTA index, there's nothing in it except trend following. The other stuff that they add to it doesn't add anything. But yeah, this there's the some of them did badmouth the Turtles, and I think it was just and Richard Dennis. It was just like a marketing thing, just to put them down. And one in particular, he continues to. I've posted about it, and he continues to kind of uh, say erroneous things. I don't know if he knows better, if he doesn't, or if he's just spreading things that he knows is not true, or if he just doesn't know any better. But of course, I think Richard Dennis kind of probably invented the whole ATR thing and sizing trades, of course. And oh yeah, and one of the things he likes to throw out more than once. You can Google it, but it's stuff like the turtles he describes the turtle as Richard Dennis. He usually doesn't call it by name, but he doesn't say Richard Dennis by name, but probably says the turtles. And they were taught by floor traders who just come off the floor and come up with a few rules, and then they start trading. Totally misrepresenting the amount of Bill Eckhart, which was an esteemed mathematician, and the amount of computer capability and backtesting capability they had in the 80s, for God's sake. So yeah, it's kind of just what they had to do. They really have always been. I think in their first few years of trading, the Europeans, they were very interested in their legacy at such an early stage, and that's a little baffling. I think you should trade for 20 or 30 or 40 years, and then versus massaging your legacy after just a few years of trading. So I'm not really sure why they did that.
Hey everybody, I hope you're doing fine. On the ATRs and the dynamic position sizing, yesterday I had a great day. I did speak to a prospective client from a brokerage firm, a person essentially, talking to, he has clients and they might be doing managed accounts and things like that. And I was explaining to him how I trade the trend following system and that there's no vol controlling and no value at risk. And I was kind of like, well, maybe I shouldn't say that, because if I say there's no value at risk and none of that type of stuff, maybe he's going to be disappointed that I'm not doing it properly and that there's too much risk and that I don't have it under control. But I just talk to him like I talk to you and tell him that's how I do it. He said he absolutely loves that, and he will try to raise some money for me, which obviously I'm very happy about, because he said there really almost isn't anybody left doing it that way, or speaking about these trades in such a clear and defined way. He said some of these CTAs, you don't even understand anymore what it is that they do, because it's become too complex, or they make it sound very difficult and sophisticated, and that they need to have a leg up and justify their performance fee and all that type of stuff. But it becomes a big pot of spaghetti, and you just don't really know anymore what these traders do. And I think he just loved the fact that it was different here. It's like, look, I mean, you could really have a very good guess at my position when you just look at the chart and you look at the breakout. You probably know what I'm long and what I'm short, and the sizing of the thing is actually not too difficult. And we're trying to hit the ball out of the park on some of these trades, and sometimes it works and many other times it doesn't. He just loves that. Kind of like, and that just made my day. Like, this was the best compliment all week, to hear from a prospective client that this guy was just really thrilled about classic trend following. So that was the best part, really.
And I want to say that I noticed that when these complex guys, they say how wonderful they are and so on and so forth, and there is no will manage and so on. I personally, I don't see any evidence, no track record first of all, and something like that. I don't see any evidence of them being successful. Only their words, only their formulas, only their predictions, and nothing else. And here in our classical trend following, we can see our philosophy. We can do backtest, and we can see this truth is simple, and we can check it. And I have said before that the truth is checkable. It's a quality of truth, I think. And some complex models, I even don't understand how to check it, especially prediction models. For example, I don't know how to check a prediction model, and I don't want to do it. So our classical trend following approach is really the best, and I think I have said before that people simply don't know about it, don't know all the things, all the features. I think it's a problem. Not educated clients. So that's my point.
The TTU will bring up this whole idea of frequently it's often said on there that, well, um, that it's okay if you do it either way. If you want to vol manage, that's great. If you don't want to vol manage, that's great. Frankly, I've never seen difference between the two performances. And I'm like, well, you haven't seen differences because there's 5 people in the world um, who use Classic. And so Moritz, Jerry, Richard, Mulvaney, Mike Melisinos. Okay, we're taking applications for other people. And but no one is like, there's not a category of all 5 of us in this little club we have. It's everybody in the managed futures space is doing the same thing. So, but I do think that that's the way to look into it, because if in fact there aren't major problems with the dynamic position sizing, then I would have to say that I'm wrong. There are major problems, and if they don't show themselves, then I'm wrong. I think you can't go through these periods where you don't have the long-term trends and taking profits prematurely before a change in trend based upon breakouts or moving averages. Then I think that can really make it look a lot better. And but at some point in time, due to the inherent issues with that type of trading, it needs to show its inferiority. If not, then they're right. You can just basically do whatever makes you feel good, as long as you're kind of doing trend and you're trading a lot of markets. You don't have to trade too many even. But I think another thing that is very interesting is when I listen to that podcast, and even is that whenever this whole idea of volatility management comes up, so someone will write in for a question or whatever, they chuckle, and even Moritz on this podcast with Richard said, like, well, we don't want to talk too much about this volatility management. And we've talked about it so much, and we have. We talk about it all the time. And the reason we talk about it is because it's the thing to talk about. So, like, the chuckle is like, oh God, here we go again. Like they chuckle like, oh God, why it's so stupid, it's so silly to talk about this. But it's really not. It's the issue. It's the huge monster. There's no other issue that even comes close to this. I would almost say it's probably way truer that, yeah, if whatever you want to do with your trend, medium versus super long, yeah, whatever, 60 markets, you're not going to die trading 60 markets. You're not going to be vastly superior trading 300. But no, this is the issue. And the whole chuckle is because they know it. And so let's make light of it. And let's sort of say, if you're dumb enough to bring it up again, then we're going to laugh at you. But because this is the issue. And it's like in America that we have one, this is my opinion. I couldn't think of a better analogy. Okay, so this is being honest, but I think we have one major economic issue as separates the two parties. And it is the issue. And it's the first thing each party does when they regain power. And that is the marginal tax rates. Republicans want this lower marginal tax rate. They want to rely upon business to generate these jobs and generate this wealth and reward people for investments. And Democrats are like, no, we need to have higher marginal tax rates and we need to make life more fair and people to pay their fair choice. And we don't even really agree necessarily that these rates mean a lot. We don't really like capitalism that much. And this is the big issue. So to never talk about this, of course they talk about it. And that's what they care about more than anything. And so at the heart of classic trend following is trade by trade, these discrete trades, and separating the trades from winning trades, which you let run, and the trend determines when you get out, and these losing trades, which you handle much differently with a small loss. And then, as Moritz said, it becomes I forgot what you called it, what you said they called it, but I called it a soup. It's like this big soup. There's no stop losses. There's like no discrete signals. You're increasing, decreasing positions based upon vol and correlation all the time. There's no sample size because they don't even care about counting the trades. They don't count the trades. They count something, maybe the days in the back test. I don't know what they're counting. But and this is the whole issue. There's nothing really left to talk about as you compare these two groups. And I feel very confident to put it front and center and be obnoxious and suffer with the chuckles and the laugh and, oh God, here we go. We're going to talk about it again. It's just a defense mechanism for them because they don't want to talk about it. And I do want to talk about it. And then once again, someone can come up to me and say, look, where is this difference? Where does it really manifest itself? You talk about it. You want to talk about it. But really, where is the performance difference? And maybe I'll just say, yeah, you're right. I did talk about it. I did say it was this big fault line. But honestly, yeah, you're right. But I'm pretty confident that over time, as we may need more years than we've had so far, we will start to see the issues, the robustness issues with trading with this dynamic position. I hate that dynamic position sizing too, because it kind of waters down, I think, correlation management and volatility management is more descriptive.
I love that. I think it is the big elephant in the room. You're right, and I have a very clear opinion on it. The opinion which you know, and Clever Moritz and I were actually working on a Substack article to hopefully put this to rest. Because we thought, like, rather than talk about it, let's put it in writing and see what people have to respond. And look at the facts. The thing is, vol control trades, we've said this many times before, they're not cost free. It does come at a cost, not only at a statistical cost, because it impacts your trade distribution, it impacts and worsens your average loss, all that type of stuff. But you start with the bare facts. There is a commission to be paid. There is slippage. There is a bid offer spread. There is an additional cost. That's one thing. And then these trades, it is impossible for me to really count them because they're not trend following trades. They're overlay trades that are a function of volatility and correlation that has nothing to do with trend per se. Like a change in volatility or a change in correlation is not the stuff that gets me excited or my trend system excited. That is just not what I'm looking for. I'm not pointing at volatility or correlation. So it's the wrong input source. And then it does really put you into these mean reverting, profit taking trades. And this is how I think if somebody told me today, oh yeah, vol controlling trades are so great and you have to do it, and if you don't do it, you're stupid. I said, look, you're actually doing something that is the antithesis to trend following. You're supposed to follow the trend for as long as you can until the exit is elected, and that's it. That is the simple trade. And if you don't do this, if you're taking risk off prematurely, if you're reducing your position size or dynamically changing your position size, then that is no longer a trend following trade. And I think that we can show in the numbers that the vol control trades essentially become mean reverting, profit taking, premature profit taking trades. And that is the opposite, is essentially introducing a mean reversion convergence system into your trend following program. And it's no longer clean. When you think about an easy example, you have take the orange juice position, right? Or whatever, cocoa, for once it works. Great, fantastic. Coffee, whatever market you're long right now, where you have a big open trade equity. Well, naturally, that position, when you think about an example where, say, crude goes from 60 to 120. Remember 2 years ago, it kind of like was that. We took it from 60 or maybe even from 40 to 120. But let's say we take it from 60 to 120. Now, that position obviously has a much bigger footprint in the portfolio now at 120 because the notional exposure has doubled from 60,000 per contract to 120,000 per contract. And it therefore moves up and down, and you can kind of like see it every day, and it becomes the market that you look at. But only because it has made you that money. It has contributed to your performance. You love that position. It's great to have it on. That's the thing that you want. Who knows? Maybe it goes to 200. It is obviously more volatile. When you measure it now, it will have more volatility because it contributes much more to the P&L of your portfolio. It is a bigger thing. It is the elephant in the room. Why do you want to reduce it? It is a profit-taking and mean-reverting trading behavior that you're introducing. You can mirror that symmetrically on a short trade. And we want to put this out in the next couple of weeks. And I hope I get a lot of hate from these people for it, or well, not hate maybe, but comments, like nasty comments, and then we can go back and forth in it. But this really, it is really this is a thing that is. Let me just say it's wrong. It is, and somebody, I agree with Jerry. So it's kind of like we need to tell them, like, you're really off. You're doing something that you're not supposed to be doing. Don't call yourself a pure trend. You're not a pure trend following trader. You're something. You're whatever, like a quant that has a little bit of trend in it, but you're doing all sorts of stuff. Don't confuse you with me. I'm doing it. I'm doing it different, and I think I want to show that I do it in a not only cleaner way, but also in a better way.
And I have mentioned many years ago, maybe 7 or 8 years ago, that before big trends we see a long period of consolidation, and our ATR is low. And it's real beauty of trend following when we enter the trade with low ATR, and then we have this rally. And we have seen this many, many, many times. We have a lot of samples here. And why not having this? It's one of the beautiest things in trend following, I think. Not the only beauty, but one of the main beauty. And so I simply don't understand guys who do this dynamic position sizing. And of course, I don't accept it for myself because I truly love to see how I enter with low ATR and how it rallies after that.
I agree with you guys, and I agree with Moritz. I think what's happened is in this complex world of statistics that these modern sort of quants are adopting, they're borrowing from the convergent part of the distribution to smooth out their trades. They're not 100% divergent traders. So all of our efforts are dealt with at the return stream level. So we don't apply our efforts at the portfolio level. We're applying them at the return stream level, where we build into those return streams these asymmetrical positive skewed properties for every single one of our return streams. But those that apply risk management at the portfolio level, they're changing the return streams, that the balance of the return streams, the relative weighting of the return streams, that sort of change all over the place, where they're adjusting their portfolio as opposed to the individual return streams to manage their risk. And I think that is a classic property associated with borrowing from convergence. In other words, borrowing from principles of mean reversion. So they're not purely divergent. They're not out in the tails looking at cutting losses short and letting profits run. They're tampering with their profits. They're not letting them run to their conclusion. They are effectively playing around with at the portfolio level to smooth out their returns. They're losing some of the qualities of the divergent nature of our trend following strategies, where we can find that the non-linear properties of these tail regions are totally unfathomable. What they're saying is that, hey, we've got some additional statistical information that allows us to manage portfolios out in these chaotic regions, that they're really not getting any information from the divergent tail properties. They're borrowing it from the convergent premise of the distribution. And so they're a quasi-divergent plus convergent approach. And people ask me, well, recognizing that there are two edges for a quant trader to extract alpha from the markets, being the convergent peaks and the tails of the distribution, they say, why don't you invest in both trading strategies? And I'll say to them, well, the real reason that I don't invest at all in convergent styles is that the premise of reversion to the mean, the premise of oscillation about an equilibrium, is a very small type of price change in the scheme of things. When you're dealing with complex adaptive systems that go through these major transition events where the total environment changes before and after in the regimes that occur between the transition event, you find that the major change of any complex adaptive system is associated with these transition events between regimes. So these convergent styles of trading they're borrowing principles from the regimes themselves, using statistics as a means to say, oh, look, the trend's gone too far, we've got to reweight our portfolio accordingly. They're not actually taking advantage of the transitional properties between the regimes, and that's where I think that it's an information deficient area. They're suddenly saying, well, we've got additional information in terms of volatility, etc., to manage our risk out in these chaotic regions. But I think that's a bit of an excuse. I don't think that there is that information available in those chaotic regimes, and so the net result is that they produce these smooth equity curves which lack the necessary lifting power that we can achieve with our classic models. And I'm looking forward to your piece, Moritz. I certainly will be reading it closely, and I hope to give you a lot of support for it.
I think it takes too much information from the past and predicts that the markets are going to be very similar. The good thing about the one entry, one exit one stop loss is that it really, you run this in the back test and you're like, oh God, I don't really like that. And then you say, well, let's move the parameters around a bit. Let's become longer term or shorter term. And you run it again. And it's like, I don't like that either. And it just doesn't allow you to do too much except say, wow, this is what we're going to get. We're going to make this profit, and we're going to have twice the drawdown. Max drawdown is going to be at least twice our average profit. Our Sharp is going to barely be around 0.5. But I'm pretty thankful that it just forces me not to do too much and not to rely too much on what's happened in the past. But I have run these systems before. When we ran them a long time ago, we would put a minimal profit in there. Like on day 2, you're going to resize it. Like, no, we're not going to resize on day 2 of the trade. We're going to let's see what happens if we build in like a certain amount of profit. Like it's a material profit, not an outlier quite yet, but it's getting there. So let's resize. And God, we never thought it's never even crossed my mind that we would increase the position. Oh my God. You can see how that can just totally blow up. And so we would do that, and the computer is very good, and it just sorts through all this data, and it just tells you the exact parameters, beautiful, to smooth that thing out on the correlations and the volatility. And it's just so tempting to use that stuff. But we never. So I think that the ultimate problem, of course, is that it does make less money. And you must introduce Sharp. And Sharp in that particular way doesn't revert, it's not correlated to your real risk of capital. And then I think you must also, whenever you explain stuff like this, you must include the very importance of using closed trade equity or something similar to that, and not total AUM to size your positions, because it kind of goes hand in hand, because you're trying to really preserve a number, an actual thing that exists, all of the capital and all of the closed profits. And with the bottom line being that this is the way that allows you to trade a robust system that's very lumpy, and you can take all of those trades and not have to do frequent cutbacks or add additional rules to preserve that equity. So do you want to preserve capital, or do you want to preserve all-time equity highs? And like all your metrics are from all-time equity highs, or how well did you do in preserving that closed trade equity? And that's just a much easier game to play.
And I want to say that we have a very big advantage in our classical programs, that we are not warehousing risk. So of course it cannot look so good and not feel so good for clients, but we are not warehousing risk, and we are very safe because of it. And a lot of different strategies, not only this dynamic position sizing, but a lot of different strategies warehouse risk, and after accounts blow up or have a big drawdown, people understand that risk were there. And it's very important to understand the real measurements of risk, not sharp, not this all smoothness, but a real measurement. It's one of the most important things, in fact.
How's it going, Alp?
Hey, Jerry. Hi, guys. It's been such a week, and I'm now putting these tweets about short-term trend trading minute bars. You're talking about the elephant in the room, but from my perspective, there's it's not only the volatility management, but just trading daily and weekly bars is also another elephant in the room, and I will say is bigger than volatility management. Now, in one day there is 1,440 minutes. Okay, one day. So when you're of course trading daily bars, you're actually trading 1,440 minute bars. So that's so if you can trade 1,440 minute bars, there is no reason why you cannot trade 720 minute bars, which is the half of the daily bars. So one of the things about trading is, I say it is the trend following is, and the way I interpret, one of the things that I've learned from Turtle experiment is the non-dogma, and that's very special to me, that philosophy of non-dogma. And when we are talking about managed futures, what is the distinction between managed futures versus what I am doing? A classical trend following trader who trades minute bars. I say dogma. Their dogma is you're gonna do it this way, real-time risk management. And if you don't do real-time risk management, you're in trouble. We don't engage with you in any business terms. So that's there. And of course the second, there are many dogmas in this industry, isn't it? Just doing this, not touching into the minute bars. You're trading 400 minute bars, but you don't want to trade 700 minute bars. Just cut those minutes to 2, man. It will work when you do that. You don't have to trade 400, 1400. Just trade 700 minutes. It will work, but not many people are talking about it. And that's I would say that's another elephant in the room. And apart from those, there is another one big one, And there's another elephant as well. It's not only the volatility management, correlation management. It's not only the minute bars, but also I said another one is taking these short positions with single name equities. You cannot imagine there is this relative momentum folks in Twitter that, long only. There's long only crowd out there. And, their religion is to take these, long only trades, but it's also dogmatic. It's also one way, you know, there are lots of benefits of taking those short positions in. And, when I post this thing on my tweets, it was, it didn't actually, people even didn't bother as much, in seeing or providing a response. No one else is interested in taking those shorts because everyone knows that, those long equity positions are making money, but not the short ones. But actually, there are lots of benefits of taking those short equity positions. And even though it might be, Jerry Parker sometimes says that we are trading equity since 2000, so it's like 23 years of trading equities as an experience. But I'm watching Twitter is unbelievable. There's a whole bunch of relative momentum people out there. They wouldn't touch on a single short trade on the single name equity. So that's another dogma out there. So I say things are changing. Is usually the right thing to do is the hard thing to do. So there is, all the things that I've just mentioned are harder, and all the things that I mentioned are definitely is the things that going to give you edge. But I say, we just need to continue with this non-dogmatic approach because the taboos are there, the establishment is there, and it's not possible to change anything else in that establishment. Is when Moritz and Richard wouldn't even talk about minutes bars trading. They are kind of an establishment on their own when it comes to trend trading. So the establishment is everywhere else. When you're trying to break it into bits and pieces, I say it's a long journey, but every day we learn something else, and so it's very interesting. Thanks a lot, guys.
Fair enough. I'll let you get away with that. We're not there yet. We gotta keep hammering on us as it relates to the hourly bars. I mean, I kind of like it a lot more than what I used to think of as short-term trading. So, but I'm certainly not there as incorporating or even including it necessarily as an option in my thought process. But I think you're exactly right on some of the other things that I do agree with. And I was thinking about this the other day, this dogma that we all are sort of infected with. We're all infected by how we think about the stocks. And we're very inconsistent. And as I've said before, that was the first thing when I started trading equities, I told myself, look, these equities, they will come into my world the way I do things, just like the commodities, currencies, and interest rate markets. And I will not pay any attention to their world and how they talk about them, how they approach them. But I found myself being this contamination. I kept thinking, and I'd have these thought processes where I was still thinking in terms of long only, S&P indexes. This was what you're supposed to beat, and this is how you're going to be measured. And so, and it's just really difficult to get away from that because, like, I have a few. Oh, like for the longest time we were short every single interest rate contract, and now we still pretty much are. We were long the dollar versus almost everything. Um, Commodities were very long, 20 and 21. And I didn't like it because you need to have some shorts. Shorts are good on their own. What short? Any short. Any short is good. Longs and shorts is good. You can't force it. You got to follow the system and do the trends, but I prefer to have some shorts. And of course, I prefer to be long and short the currencies, which I am now. I prefer to not come in every day massively short interest rates. I'd like to have some longs that are trending. It's difficult now. The commodities, they're more mixed now, some longs and some shorts. And so on the bad days and the bad weeks and months, just having longs and shorts is a risk reduction. But no one thinks about that these days when it comes to these stocks. All these managed futures CTAs are long all these indexes. They're all in uptrends pretty much. Almost none of them are in downtrends. And that's okay. Look how much money we're making. And I'm just like, oh, like I'm like 75% long and 30 some percent short. And I'm not making this money on these stocks because they're, until the past couple of days, they keep going up and they're really strong. Nikkei, very, very strong. And so I'm sitting here and my stock portfolio looks like my currencies. Got some longs, got some shorts, not crushing it because I'm not only long. And like I got to keep telling myself, no, no, this is how we do things. This is fine. Um, and there's so many great. I get on some of these shows and podcasts, and people are like hammering me with this S&P stuff. I'm like, oh no, no, no. I understand that there's 4 stocks in the S&P that are leading the way and making all this difference. But like I'm long a lot of like building material companies and miners and things like that, and um, uranium stocks and things. So like I've got this vast portfolio of longs and shorts, and so there's a lot happening. Well, but you're not making as much as the S&P. No, no, I'm not, because number one, I built my portfolio on diversification, not tech stocks or AI, and I tried to get this. I wanted this diversification to yield shorts as well. Oh, well, that's kind of weird, but stick to your indices, and maybe I'll give you a 5% allocation for Crisis Alpha. I just got the Mulvaney report uh, plus again last month, almost 9%, up 49.7 for the year. Far cry from his 88.5 last year, so he's kind of slipping.
Still, Jerry, that's an amazing result for the year to date. I can't believe it. It's amazing.
Yeah. I'm pretty sure he is, with us on the Letting Profits Run. So I can't swear to it, but he's enough. I don't think Yuval manages. Yeah, he's a solid guy. I mean, what a great trader, and he's certainly one track record that you can point to that looks to be leading managed futures. Okay, if no one wants to comment on all of what I just got finished saying, I did want to move on to another tweet. So you remember the tweet we had a week ago where Mark wrote this thing about analog versus digital? And I'll let Moritz and Richard describe it better than me. I'm just going to be very quick and say it was kind of like if you trade with sort of a continuous system that is always long or short, and you're adding and subtracting based upon trend and correlation and volatility, then you're going to have this more probabilistic approach, and it's moving. You're increasing when the probability is higher, and then you're decreasing when it looks lower, and then it's going to be smoother, and it has all these qualities. And then that is in contrast to the old-fashioned approach, our approach, which is, I think it was digital, and which is one entry, one exit, a stop loss, and it's all on or it's all off. And then I brought up the point where, well, you can minimize that issue if you trade multiple digital systems where you're adding as more breakouts get hit and subtracting as more breakout exits get hit. So I thought that was, so we kind of beat that horse to death. However, then I'm really good at this. I'm really good at this. I think I'm good at it. Of course, I've missed some things. As to wait, and then you'll see another piece by the same person come out that's sort of the opposite. Okay, so I think this is kind of the opposite. I'll read the tweet that I posted on July 2nd from this article that Mark wrote. Again, another later article. How do you detect skill in a trader? Question mark. Instead of focusing on sharp, the emphasis may be better placed on frequency and magnitude. That is, how often does the strategy make money, the win percentage, and how much does it gain or lose when it is correct or wrong? Breaking trading skills into these two parts makes it easier to compare traders to measure timing and magnitude skill. This approach will provide deeper insight into the type of skill any trader may possess. In other words, trade stats, which are win, your average loss, your win percentage, your loss percentage, your average trade, the expectancy, the expectation per trade, the trade stats. And this is what I look at when I do these back tests. And I sort of say, yeah, this is good for back test as well, right? You don't want to mess around too much with historically this equity curve that has been subject to the fundamentals of the 70s, 80s, and 90s and 2000s. You kind of want to keep adding these trade stats together and determine like, okay, this could be something I could trade. Have no clue what the equity curve is going to look like in the future. Don't want to use equity curve stats. So this was my whole point. And so I think this, in some ways, this is what you get when you have these digital systems. You actually get to count these trades, even though people mistake how you're supposed to count them. You have to have the buckets.
Yeah,
Same entry. Yeah.
Jerry, I don't understand the difference between digital and analog in the sense that, you know, what what I'm doing as a classic trend follower is probabilistic. How can be the digital be less probabilistic than the analog in that sense, just because they are doing the volatility management? How does it work? What is their definition of being probabilistic, less probabilistic, or more probabilistic? Doing the correlation management, wall management makes them more probabilistic than the digital. So is it possible to explain the logic a little bit? Thanks.
Right. My instinct was when I communicated offline in emails with Moritz and Richard that it wasn't more probabilistic than our way. And I think Richard confirmed that. So he could explain that probably. But I think, I don't really, another thing that I don't really agree with is, I'm pretty hard nosed on this. I don't agree that regardless of how you trade, that at any point in time during your trade, you made this entry, and just for the sake of simplicity, let's say, I think it's okay to we'll just sort of, for simplicity, say it's this classic trend. So you're going to get out. It's going to be a winning trade, and you're going to get out with the trailing stop. I don't think at any point in time during that trade you can say too much about that now that it looks like that this trade is going to be a big one, or this trade has increased. The expectation is increased by the profit in the trade. So if your expectation per trade is 3 ATRs on average, and then you have a 3 ATR profit, your expectation on that trade is 6 ATRs. But I don't really think that it's always going to work out that way. And I don't think it's safe to do anything with that information. I think, there's no information that I want to pay attention to in between the entry and the exit. So I think if we leave on Friday and everything today closes on its highs and we're at all-time equity highs, I don't think that is any sort of indication of next week. I'm happy for it, but it could be the peak. I've had so many trades recently come within a quarter ATR of getting stopped out and then go right back up and resume the trend and it's just pure random luck. But look at that monster sell-off in feeder cattle. I mean, and then the March rally did not hit the exit in the interest rates, meant nothing. It's back to new lows. The Bank of England can come in because they have this chaos. They can come in, do nothing to fix their chaos except they want to buy these gilts, and now they're going to hit new lows. And we're shocked. Now, there's nothing in any of these markets that means anything we can really use except the entry and exit signals themselves. I don't think anything within that trend in between the entry and exit gives us any more or less hope for how that trade may turn out.
I like the idea idea of Jerry to take as less as possible from the backtest. Yes, it's really a great approach, I think, because one of the main aspects, I think, from in our philosophy, one of the main things, it's our unknowing the future situation. So, of course, when traders, CTAs, maybe managers, tells that they can predict the future, it attracts interest of investors, but it's not a truth. And our approach that we are not predicting, we are doing our math, we are doing our backtest, and take as less as possible, take the main things, and it makes us robust, simple, not fragile. It makes us strong. So it's a big strength and big advantage in this idea.
I'm looking into the backtest, to be honest, but it gets a little bit more challenging to backtest like 20 years from now while testing the equities, because there is this inherent portfolio selection issue with the equities. And what happens is sometimes these equities, like small and medium-sized companies, are being acquired. So, they're no longer around. And when you're trying to do a backtest from year 2000, 2001, 2002, 1999, so, it is a little more challenging. It's always easier to put a back test with the current set of active single name equities, but I say it's that sort of an exercise gets a little bit more murkier when you come to the 1990s, because a lot of stocks are not with us, and there are lots of corporate actions that has happened. Spin-offs. No one talks how they are trading spin-offs. How are you trading spin-offs, Jerry? I mean, when an organization just takes out a business and becomes a new stock. So this week I was actually trading Lab Corp of America, just a medium-sized company, I guess, and there was a spin-off. So the actual trade just went down. I lost 2 times the risk that I put on the stock, so it just gapped down charts, and I ended up with a new company. So this new company has been given exactly the same loss that I've ended up with that company, but it is a new business, so it's called a spin-off. And there's no price data, of course, nothing else. So it becomes it's not a big position, like 25 basis points. Who cares? But it's interesting to see those sort of corporate actions happening. Spin-offs, mergers, and these are all the things that puts the backtesting process quite a bit of challenge, I would say. These backtests are way easier while you're trading the stock indices, because those stock indices do exist 30 years before. S&P is around God knows how many decades now. But if you're trading small and mid-sized companies, then you need to come up with a backtest process that you can still rely on and say, okay, my strategy possibly, and you wouldn't get that. No, it's not. I mean, it's a completely meaningless number to look into the 1990s with the sort of trading that I am doing, because those small and medium sized companies are not around. But still, we have to rely on a back test in some shape or form. So it becomes more of an art than a science at times to be able to see what would have been happening. So that's one challenge. And the second challenge would be, of course, the costs. In 1990s, in 1980s, these small and medium sized companies, it might have taken like $200 to trade one direction, right? Now I am giving like maybe $5, $10 or something else like that. I mean, so whatever I'm trading, it wouldn't have been possible to trade it in 1980s or 1990s because the costs would have been so high. So I'm definitely using a time machine while I'm putting those back tests together. So really, are those back tests reliable? Of course, they are not reliable. These results are not there. These results are just purely looking into the future. But still, why I'm using it? I have to. That's the only measure that I do have to be able to come up with a more empirical approach, a more scientific approach, to be able to manage my risk budget. So that's what happens. Thanks a lot, guys.
I think the problem, though, with back tests is that back tests inherently give you a probability based on history. Now, when we're trading these tails, these chaotic regions, there is always uncertainty associated with any probabilistic estimate. And what we actually find with our models is that they're thriving on the uncertainty, not on the probability. When you use a back test as a basis to do any kind of forecasting of expected future returns, you are basing your premise of that historical back test that we're going to get a repeat of these back test conditions into the future. I think that's the wrong way to do a back test. I think a back test is a way to validate a hypothesis. In other words, a back test should be used as the environment where you try and break your models, because we all apply models to trade these markets, and there is no model that is the actual reality. The reality is distinct from the models we use to apply. So in strictly keeping to the scientific method, what we are doing is using a back test as a way to validate a hypothesis. If we find that our back test produces more risk events than we're prepared to tolerate, we take attention to that. But we don't use a back test as a basis to form any kind of projection into the future when we're dealing with uncertainty and we're dealing with a massive degree of variation around any form of probability estimate associated with history. Because what we find is if we're relying too much on our back test, we are inevitably optimizing or over-optimizing our models in accordance with what history is presented. And I think that's a mistake with trend following, because we're not dealing with predictable repeating conditions. We're dealing with these anomalies, these chaotic tails, where it's information deficient. There is no information we can get to apply, this finesse to be able to assume that we can, as we sort of enter a trend, there is no further information that we should be applying to our models if we are targeting outliers. For those that aren't targeting outliers, upon entry, they might be relying on information based on convergent premises or from back tests that tell them, there is a bit of extra information I can glean from this information after entry, and I can therefore adjust my models in a continuous way because there is further additional information that's giving me a higher probability estimate. But I think that's the wrong way to think when we are targeting the edge associated with the tails of the distribution that are chaotic. I think once we make our decision to enter that trade, at that point of entry, we don't know whether we are actually on an outlier at that point in time. So at entry, we are making all of our decisions in relation to how much risk we are prepared to take with that trade. We set our stops, and those stops are set in place to give freedom to move for a future potential outlier, recognising that we do have information available from the normal distribution to be able to set those stops within a certain distance away from our entry to allow freedom of movement. But then from that point on, we want to make, if there are any changes we make, it might be made with a trailing stop, but certainly not with adjusting position sizes that are introducing trading costs into our model, additional trading costs. We don't want those additional trading costs, but what we do want is loose pants. And that loose pants between entry and exit is a deliberate mechanism, because we're saying there is no information we can obtain that's going to assist us in trading these outliers, because they can take so many different various trajectories. There is no additional information from the particular trend that we're trading at the moment that is going to assist our cause. If we really want to target these outliers, if we really want to let our profits run, we don't tamper with that trade after the decision is made to enter that trade until our trend systems tell us that the trend has ended. That's when we take our exit position, and that's all of those decisions are based on freedom to move, freedom to exhibit properties that we've never seen before in our historical record. It's allowing a trend to do whatever it wants to do without a prescriptive definition, using probability estimates, fine-tuning, continuous adjustments, because we know better and there's additional information we've got. I think that's a real problem associated with a lot of these more advanced trend-following models, and that flows through into this discussion of dynamic position sizing, volatility targeting, all of these things. They are overlays that are saying that there's additional information we can extract from the nature of the data at any point in time between entry to exit of our trades at the portfolio level, where we can adjust things to get a bigger bang for buck. All of those decisions are coming from the back test, from the statistics from the back test, which is giving them their probability estimates that this is a good move. I'm saying, no, if you're targeting outliers, do not rely on your back test or the statistics generated from it.
But you don't rely on it, but rely on some of the things, right? So, when Jerry Parker or when Richard speaks about backtest, you're not going to rely on it. We actually rely on it in so many different ways, but there's a limit that is to be relied upon those backtests. So, while deciding at which point to enter, I rely on my backtests. Or, what is what sort of a maximum stop loss I'm going to use, I rely on the backtest. When deciding where to exit, yes, here you go, I rely on the backtest. And of course, when you are automating this process, okay, you automate it from your backtest. So the backtest becomes the process that you actually take those trades on live as well. But so there is a certain things that we rely on, but what I don't rely on is the non-stationary properties of trend following. And when Richard speaks, so that's how I interpret what he speaks. So these non-stationary properties are the mean, the variances, the skew, all these properties of my historical backtests, subject to change. Because so I cannot just rely on the fact that, all right, I'm getting 20 losers in a row, so I must not take that 20 losers in a row as the golden source. Or I am making money 40% of the time, so okay, let me go and create a Kelly criterion to size my position so that I can make more money. So I am not using the statistics of my backtests to be able to size my positions, or just use those statistics in any shape or form in a much more precise way. But I'm using those statistics as more of guidelines, and what the past might have produced, and just proceeding very cautiously while those systems engage with the uncertainty. And if things go wrong, so far they didn't, but there is always other risk management tools that are in place to be able to tackle those moments. But the win rate, the loss rate, the losing streaks, not I really, like to see, nothing more than 20, 25 losers in a very diversified portfolio. But if, I don't know whether I'm going to hit by 32 losers in a row at some point in time in the future. It's just, I wouldn't bet on the statistics that are produced by the backtest, basically. Thank you.
Yes, look, I tend to agree, Al, but in developing my models, the first thing I'm doing is I'm applying design logic. So what I'm firstly doing is under discretion, I'm saying, I want to trade trend following only. That's a discretionary judgment because I could trade convergent, but I'm going to trade divergent trend following models. Discretionary design logic. The second thing I do is I say, how do I trade and what systems am I going to deploy for that logic? And I say, I need breakout models because I don't want to miss the outlier. I must catch those outliers, can't afford to miss one of them. I will supplement it with these additional trend following models. All of them are going to have as small a bet size as I possibly can get. That's not through a statistical judgment. That's through the fact that I recognize in my logic that the smallest bet that I can apply at the per trade level allows me to achieve maximum diversification across my portfolio, across markets and across systems. So it's not a statistical judgment. I need the smallest possible bet size that my finite capital is going to allow. And then I know that I need an initial stop and a trailing stop or an exit from my trend of all of my models. And I want all of my models, this is still at the design phase, without applying any form of statistical judgment, I want them to have fairly uncorrelated properties with each other. So each of my systems need a slightly different entry. They need a slightly different initial stop, a slightly different trailing exit mechanism. So there is sufficient diversity in the designs to enable sort of an uncorrelated logic to unfold. That's my hypothesis. Then I apply that into a backtest environment and I say, is that logic sound? So I'm looking for weakness of that logic. I'm testing it in the backtest environment. I'm not data mining in that backtest environment to develop my models for me. What I'm doing is I'm testing that logic. Is it robust? Does it have any risk weakness? I'm looking for my hypothesis to be invalidated by a false event. In other words, one falsification of my hypothesis tells me that my model is not sound. This is a scientific method being applied here. It's not saying that I can apply my statistics in the backtest to choose the optimal model. I'm rather testing the logic of my models to look at the weakness. And therefore, once I'm satisfied that in the backtest environment, the logic is sound from my design logic, that's as much as I use my backtest for. I then apply those systems into this uncertain environment. One of the criteria I'm looking at is how well do these models capture historic outliers? How have they been able to capture all of the outliers that have been presented in the past? If they have, and I use a visual mapping method to look at all of the outliers, that's a big tick. Those models have passed that criteria. How much have they mitigated risk on all of the adverse regimes where outliers haven't been present? If it passes that criteria, I know that my stops have been, and my trailing stops, and my risk mitigation mechanisms have been applied correctly. That's another tick. That's as far as I can go with a backtest because I know that in the future, there is no map of the future. There is no plan for the future. I don't know what it's going to deliver, but I do know that at least over the past, my model has been validated. That's how I use a backtest.
And also, over and above, I like to use some additional data that I don't trade to be able to test my models. So, for instance, I'm not using ETFs, but I backtest my systems with ETF data. I also do not trade, every stock. So I do have around 70 stock portfolio, but I test my systems with hundreds of stocks, because some of the data is just there, is very easy to access to. So I like to throw new set of data, even though I am not trading it, and to see the responsiveness of my systems. And even at some point I was thinking whether is it possible to come up with my own data stream that I produce in-house, more of a random basis, and test my systems like that. And in my experience, there's always a new learning happening, when I throw new data to my existing models. And there are many easy to access data in this times, available on the internet. So I suggest everyone else to to you know to do the same. Thank you.
And I like very much our idea that all our principles are universal. We can apply the the same principles to the different markets, to thousands of markets, and so we can have a very big sample size, a very big amount of backtest. We can see different regimes, different market situation. Some stocks are not in a list anymore. Some stocks are very new, and we see everywhere. We see the main things we apply. We see it everywhere, and we see that, like Jerry said, that trend following strategy will improve all the markets. All the markets will make money for us if we apply trend following for this. And it's great. It's a big strength of our approach.
So look, one of the things on my back test is now is shorting the stocks. All right. Now I know that Jerry Parker is taking a short position on large caps, but on my minute by minute systems, basically, it makes much more sense to short the stocks that I am going long. All right. So this means that I don't have to short the large caps only. Okay. So when I do, of course, I'm going long small and medium sized companies because they produce better outliers. But they are not only producing better outliers if I trade them long. If I trade them short, they do perform much better than the large cap ones as well. So trading those small and medium sized companies are making sense both while going long and short. All right. So that's hugely powerful idea just there. But then again, I'm not relying on my back tests in the sense that, there might be an acquisition activity. So there are risks around taking a short position in small to medium sized companies. So, I have to either go and, buy an option to protect myself if I want to go from that route, so that I am not actually being punished when there is a acquisition of a medium-sized company, which actually the price goes up 10 times. Maybe this might happen once in every 30 years. But, so that's one way of trading a small and medium-sized company on a short basis by just buying an option. Or basically I have to do what Jerry Parker is doing and just short the large caps. And at the moment I am shorting the large caps, but I'm also eating my nails, fingernails, knowing that the shorting actually small companies and medium-sized companies is just a way of a better trade. Why I am not doing it? Well, I do not want to deal with buying the options and the risk management side. I mean, no one else is talking about how they are shorting. What is your shorting strategy? But when we are talking about this, you might say we are long term, so the short positions actually are not making that amount of money because we are long term, so the ATRs are large. Okay, right. Well, I'm trading minute bars, and that's not the case. So that's, here you go, another benefit of trading minute bars. So really, the potential of going shorts are huge. Who wouldn't want to be taking the short positions? It's just, I think risk management needs to be everywhere else. And so I'm looking onto those back tests. They produce better results, but I am going and shorting the large caps, which are less productive, less CAGR, more volatility. But that's where I am today. Thanks.
So once again, I would just say, sum it up by saying, pay attention to those trade stats and not the equity stats so much. I do think you can get a basis for how big to trade, your total risk budget, and what to expect in the future. It's just going to be different and worse, possibly. So you want to be on the standby with your cutback rule in case you trade too large based upon the historical backtest equity curve. Now, I think, and I applaud, but I think you stole this from me, this idea that you put into your backtest markets that you don't even trade. If you trade 20 markets, backtest all the futures, hundreds of futures. If you trade hundreds of markets, then try to find other markets that you're not going to trade. You probably don't want to put in there very illiquid markets, but let's say you're going to trade 50 stocks. I mean, crap, backtest 150 and look, and you'll get more closer to the truth that the backtest is trying to tell you about those trade stats. So I am building this portfolio of stocks based upon diversification. So if I have a takeover, a corporate action, a merger, does it stay in the portfolio based upon diversification? I'm sort of preferring smaller stocks rather than big mega caps. Okay, then it stays in. I know how I'm going to trade it. I'm going to trade it based upon this back test, and I'm going to use the information about the trade stats as relates to how to choose these systems. So I think the ultimate question is, if I don't have perfect data, if I don't handle these stocks historically the way that they should have been handled, including some in with less data and not realizing that they weren't that big 20 or 30 years ago, all of these issues that you may have, is it going to force me to choose the wrong system? And so one of the ways that we dealt with that is that we didn't want to include too many stocks in our backtest because we were in a period where stocks were too good. They were dominating the backtest, and it was tilting our look back period, for instance, and saying trade longer term or shorter term, whatever it was. But the stocks were dominating that. But these issues kind of go away if you're only looking at what you should only be looking at, which is this the trade stats. So you don't want to, so I think you have this freedom to add markets that you have no data for, because what kind of data that you may have, if you had data for this particular market, what are the chances of this one data source for this one new market out of the 50 or 100 markets that you trade causing you to choose a system that you wouldn't normally choose, like almost zero. As you build up more and more markets and more data and back testing, the chances that you're going to change your system at all based upon new markets, regardless of how you handle them, whether you have no data at all, is going to be pretty low. So that's definitely the way I do it. Take as little from the back test as possible, but you've got to take something. You've got to take these trade stats.
Jerry, you keep on mentioning the fact that testing equity is leading your back tests average duration and your system's look back periods longer. But what happens if you back test before 1980s. I mean, to be honest, I've only backtested up until 1990s with the stocks. And as I mentioned, I'm throwing any ETF data or stock data that I can find. I trade or I don't trade. But I totally am with you when you say that the stocks are trending longer, so there is a tendency to make those look back periods longer. But I haven't backtested, before modern ages, which I call, before 1980s. Have you conducted any backtests with the stocks before 1980s? And I wonder, are you still getting similar results where you have a tendency to use longer look backs if you do that? Thank you.
So let me see if I can distill it down. I'm going to look at all these different markets over all this data, and I'm not going to separate the longs and the shorts or the different sectors. And I'm going to take whatever the group as a whole tells me. I'm not going to trade stocks longer term because that looks like it works better for stocks. Currencies are better if you trade them shorter term. I'm going to let what all the markets and all the sectors, the longs and the shorts, tell me. I'm going to trade multiple systems, so that's going to help a bit. But then the key then is don't include too many stocks. You're okay. You can't get into too much trouble if you test all the currency futures and all the interest rate futures and all the commodity futures. But then you have thousands of stocks over all this data. Some of the data has gone away. So don't include too many stocks in there that can over influence it. You're not going to pay attention to it anyways. You're going to do yourself a disservice if you include too many equities in there and you start trading longer term, because that's what the equity sector wants. And I think that regardless of what you get from this back test, all of these ideas can change over time. At some point in time, you start trading longer term on all your stuff, or you slice it out and trade the equities longer term. Then all of a sudden, in the next period, or for the next 20 or 30 or 40 years, equities would have been better traded shorter term, which is what all the data told you originally anyways.
But
So
has
I
there
think,
been any time like that, Jerry? Has there been any time in the back test? Because my back test doesn't go like,
oh, you're being way too interested in what has happened before, insinuating that, well, if it's never happened before, I don't think I should be expecting it to happen again. And that's the opposite of what we're saying. We're saying that CTAs make all this money based upon things that have never happened before, and it's not stable. We can't really predict what's going to happen in the future, especially in these tail events. The historical data is not that great. There's not that many of them, so that's why I convinced myself to not even look at that either and say, well, it's just what the average trade is, including all these outlier trades.
thanks.
Now, I did want to get to at least one more. Oh, yes. Felix posted a tweet. He needs to talk about this tweet. He's being very critical of us, I think, with the smiley face. Okay, that's okay. All right, here's what he said. The way trend following is talked about today, it's not a surprise. Trend following will only ever get a small percentage of a portfolio. Felix.
Jerry, can you hear me now?
Yes.
There we are. How's everyone doing? Well,
doing well.
Good. What specifically would you like me to comment on that comment?
What are we saying today that makes you be not surprised that trend followers won't get any more than a small percentage of the portfolio? What are we saying that you don't like?
Well, just to be pedantic, I wouldn't say what we don't like, because obviously, Jerry, I'm a huge fan of you and trend following in general. But I think the big thing comparatively is trend following doesn't really set itself apart for the specific reasons of risk management. And so when allocators, whether that be institutions or RIAs, are trying to determine how to take their client's portfolio and how to allocate, they don't really understand the inherent risk management within trend following. So they're still going out and they're trying to find 4 or 5 different funds or ETFs or whatever it may be and packaging it up. And so by continuously talking about, well, we're better at this compared to other funds or compared to this other bond fund or whatever it may be, it makes it apples to oranges and it confuses people. And then they just keep going on with the status quo. And so it just creates this self-defeating loop where, because y'all are trying to prove, excuse me, y'all, I mean, trend following in general, trying to prove we're better than the others, it just makes it, I guess, whose shoes are bigger contest, and then you're just never going to win that net. So that was just kind of what I wanted to throw in. I think Richard's talked about it a few times where, everyone has their own system. And so as long as the outliers are there and the trend following there is and the risk management there, that's what matters. But these big allocators just can't understand the difference. And that's on us as trend followers for not laying out why this is different and why it's more important versus other options.
No, I don't really have too much to say about that. I don't really think I understand specifically. Yeah, I mean, I think this conversation inevitably is going to get way, way in the weeds because that's where we are. And I would never have this conversation necessarily with potential clients or on a well, depending on if I'm on a podcast to promote an ETF, then I certainly wouldn't. I sort of want to know my audience a little bit better. But yeah, I mean, you just got to figure out when and where what to say. I don't think it gets any better, honestly, than some of the things too. You don't want to get on a kind of a retail podcast. Like I was on Chuck Jaffe talking about stocks the other day, and it was just emphasis on stocks, diversification. Let's go with the trend and take small losses, and that's that crowd, right? But now on the CTA, on the Top Traders Unplugged, that I can get more in depth, and it's all going to be in the weeds because that's what we're kind of interested in. I search out podcasts all the time, and I find some on trend following. And I start listening, and I'm like, oh, okay, that's 101. Not really interested in that. That's for RIAs, the retail. That's not me, right? I may be on that podcast one of these days, saying pretty much the same thing that was uninteresting to me to listen to. But so I think you just gotta. But I think back to what I was saying. I think the whole key is diversification, longs and shorts. You can't predict. Follow price only, and play for these outlier moves. And stocks are not superior trenders or superior money makers from all the other markets. I mean, things basic, break down what exactly we're doing and how we're doing it. And then, sometimes depending upon the crowd, you can go deeper. But I don't really. You got to size up your audience and figure out what's good. But like I said in my, there was this one quote that I copied from Morgan Housel. This one guy said, "I have 1,000 people. I have hundreds of people who don't like me and thousands of people who do like me." And I turned it around and said, "Oh, I have hundreds of people that like me. No, thousands of people that like me, and millions of people who don't like me." And so I think that's the state of trend following to some degree. That's the state of eating your broccoli. This is what I want you to do. Do the impossible. This is the right thing to do. Now, who likes me? Like, not that many. And one of my friends on Twitter said I shouldn't have said I have 1,000 people that like me and 1,000,000 people who don't. I should have said I have hundreds of people that like me. And I said, oh, yeah, I think you're probably right.
It's interesting. I think part of the problem in selling our technique is that we often don't explain things in a way that can really get across to the audience what we're trying to convey. So, typically we say, volatility is not risk. That's something we say a lot of the time. And investors will scratch their head and say, what do you actually mean by that? Because, we see volatility as being risk. But then what you've got to do is you've got to say, we've got to dig into that a bit and say, what sort of volatility are we talking about? So, trend followers, what we are doing is we are dealing with volatile equity curves, but that there is beneficial volatility and there is adverse volatility. What we are seeking to do with our technique is to reduce or restrict the adverse volatility, but take full advantage of the beneficial volatility. And that way, we develop an asymmetry with our technique that allows us to capitalize on these outsized moves and deliver strong compound growth over the long term because we have asymmetrically orientated our portfolio or our technique to take full advantage of beneficial volatility, which therefore gives us a positive skew. And you can start explaining things in a way that people have a better understanding of what you're actually talking about. And this is where you then come in and talk about how Sharp penalizes trend followers volatility, because Sharp is after these smooth linear ascending equity curves, and obviously it's penalizing any beneficial volatility that a trend follower gets above and beyond the adverse volatility that it gets. And therefore you see that there is a penalty applied in Sharp. And therefore, if you're using Sharp as a measure to evaluate portfolios, you'll naturally penalize a trend following portfolio. And this is a different way of looking at volatility. And then you can explain to them about, how trend following and some form of options trading, etc., are divergent techniques, and they can really sort of give diversification properties to a traditional portfolio, because the majority of traditional portfolios you'll find have this negative skew signature. They're inevitably, most of them are what we call positive, 90% of GDP positive. In other words, relying on economic boom times to make their money. And that's why so many traditional portfolios fall down in periods of crisis. And so that this is where the properties of trend following and some other divergent techniques really come to not only cushion the blow for the traditional portfolio, but they actually give lifting power to the portfolio. And lifting power is something that is never talked about. So in other words, the 60-40 portfolio, of course, it's a way to smooth the portfolio, because you're using these tepid bonds with very low volatility as a way to sort of reduce the overall volatility of a 60-40 portfolio, but it's giving no lifting power. And you say, supplement, your 60-40 portfolio, remove your 40% bonds, put in trend following, and you'll not only get a cushioning effect, but you'll get a significant uplift in your CAGR. So there are ways to explain this stuff that start making investors start going, okay, I see what you're talking about. But I think it's confusing in a lot of the discussions that we have about volatility, the terms we're using, all of these things that make it very complex for an investor to understand what we're going on about.
Hi, Jerry.
Hello, Absolute. Hey, Absolute. How you doing, buddy?
Yeah, pretty good. Hi, everybody. So, Jerry, do you expect the ETF to compete with your current funds? Since I'm assuming it's a lower fee compared to them, so do you expect some of your customers to move to the ETF?
Good question. Yeah, I think that it's up to me to not to create a reason for the private fund to continue to exist. So I think that it can do that. And at the same time, I've been warned and asked by my Twitter friends to don't water this down. So I'm like, yeah, I'm not going to do that. There are a couple, I trade like over 300 markets, not including the short equities, short mega caps. I don't double count those. So 400 markets. So I have to take out a couple, because they're essentially business development companies, and they have an incentive fee structure, even though it's traded like a stock. And I have to keep track of the fees that I pay to other ETFs or other things like this. So I just took that out. My acquired fund fees went from 11% to 3. I'm sorry, 11 basis points to 3 basis points. So you got to count these basis points in these ETFs. So I'm committed to having all these markets in there, and I just need to. But I probably over time it could be a struggle, because I have to worry about the market maker and things like that. So maybe something like Brazil coffee, and there'll be a handful of 10 markets maybe that won't actually make it. But I have to do better than that. So yeah, it's up to me to figure out ways to make a private fund still relevant and thriving, and really taking advantage of the higher profile that the ETF will give us. And when high net worth people come along, we say, hey, this is more of a hedge fund setup, and hear the differences, and hopefully some of them will choose the ones that it seems like would be a better fit, would have a reason to choose the private fund. So that's what I'm kind of doing, and hopefully that'll work, and it'll be a win-win for everybody. Good answer? Not a good answer?
Oh yeah, that was a good answer. I have another question, and I think I've had this question maybe 2 or 3 times before. When you guys talk about not taking too much from backtests and that you care about the statistics, about trade statistics more than the equity curve. I have a question. So if your current setup with the current markets and current strategies produces a backtest that gives like a 10-year flat performance, like from 2011 to 2021, the whatever they call that dead period for trend following, and so let's say sharp 0.5, 10-year flat period, no return for 10 years, and to 35% or 45% drawdowns like the Mulvaney fund had. I just commented with Richard. Mulvaney's fund had zero performance in 10 years and then 245% drawdowns. And my question is, what kind of investor or even a person could go through that? And let's say, okay, he survived 10 years, now he's booming and he has a great performance. But what if it's 15 years? Not 10. 10 maybe, okay, fine. He'll survive 10, but would he survive 15 years? And 45% drawdowns. So the statistics over a 35-year backtest may be good. Yeah, trade statistics, average profit, average loss. But I think it also matters how those trades are distributed over time. Because if you do have the same statistics, but in a backtest you have 15 years of flat performance or down performance, like slowly going down and up and down, kind of torturing you psychologically with like 45% drawdowns, would you still be able to survive those 15 years and 45% drawdowns saying, hey, still over 30 years, the statistics is good. I'm still plugging away. I'm just going to go and do it. And then how would you keep investors through that? So I think from the equity, why I'm saying this is, I just want to say that it's not just the trade statistics that matters, but it matters how that statistics is distributed over time. And this is where smoothness comes in. Smoothness doesn't come from I don't know, because it's just people love beauty and aesthetics, like uprising equity curves, but it talks about psychology and actually going through tough periods and actually surviving and thriving through them and after them. It's not a trivial matter. So what is your comment?
I agree. I mean, that sounds really daunting to live through that scenario. I do think that if you're looking at the trade stats, what you're trying to do is, I was sort of saying it's more like you're going to decide which systems to trade. And I think it's safer to use those numbers and decide how you're going to trade. Now, the way that I have tried to combat this many different scenarios, including the one you just brought up, would be two things, and that is add a lot of stocks and then trade a lot of markets. So I'm going to achieve this smoothness through the caveman classic trend, one entry, one exit, stop loss. We can definitely say that we can speculate that maybe more than that could be trouble, but certainly we should be given the benefit of the doubt that less than what we do is less than almost anything else you could possibly do. I guess you could drop the stop loss, and so at least we will probably achieve some profits, and the back test has a high chance of helping us choose the right systems going forward to make those profits, even though it's going to be very choppy. And you could say, and it's unnecessarily choppy. Yeah, okay, I'll give you that. It's unnecessarily choppy, but it's not like we're going to have, with the most robust systems possible, we are putting ourselves in a pretty good likelihood of doing as well as anyone else. So now, this period of the 10-year dead period was probably wouldn't be as dead or not dead at all if half the markets you traded were equities, single names, which did really well. So because CTAs relegated themselves to the worst possible trading vehicles that have almost no chance of producing an outlier trade. Nice sector moves, yes. Outlier trades, no. Then this is what I'm trying to do to increase my ability to withstand these periods like this. And so if we go through a period, the next 10-year period, where the only thing that moves is equities, I should be able to keep up and not do so poorly when all the equity people are doing really well. And there's a choice between CTA, trend following, and equities. They're obviously going to choose the equities because they like it more and they're doing better. So that's all I could do. Now, if we go through a long period where nothing is working, or currencies only, not that many people, or commodities only, not that many funds even available, I suppose that's another thing you could do. You could just start rolling out these ETFs or funds that trade currencies only, um, bonds only, commodities only. And I think that's what some people have tried to do. That's problematic because they have a tendency to have very frequent bad periods. They create the lack of diversification creates more than things that are worse than a 10-year period of not only making a few percent like CTAs went through. So I think there's only so much you can do if you're committed to doing things in the highest, best, most scientific way. You just have to suck it up. I'm always shocked at some of these famous hedge funds that have just ridiculously bad performance for such long periods of time, and they don't lose all of their clients. They still have a few billion left. So that would be a goal to figure that part out. And then, I like this Bill Ackman fund and then that Greenlight fund. That should be my next move, is to graduate from ETFs to this Ackman-like fund that is a stock and there's never any redemptions. You have to just sell your shares to someone else. And for the asset manager, the equity stays in the fund. It's just basically, are you making money or losing money? So that should be our goal. This business need to be better businessmen and not focus so much on having our amazing trading ideas bail us out all the time, because we are going to go through these periods where it's going to be tough. So we need to find someone to take us public, raise us a few billion, lock that money up into a company that people, if they want to get out of this investment, they just have to sell it to someone else. And of course, these type of companies have the premium and discount issues, but so be it. Bill Ackman, he sleeps well at night knowing he's not going to get a redemption. What do you think about that?
Yeah, sounds like a great idea. I need to learn some about that too.
I've been following, yeah, it's pretty funny. I've been following Carl Icahn. If you haven't followed his company, he has a similar one. And yes, I follow those three guys, but Icahn was playing games with his fund, and a nasty short seller came in and said, "Oh, he's playing games, and so we're going to punish him and short this thing." And it just absolutely crashed. And so you don't want to do that either. Okay. Anybody want to speak, say something before we leave, so we can get busy with this Friday, these markets, and see where they take us today? I think while you're thinking about that, request to speak or just start speaking. And so I think this My ETF, I think, is going to go live on Tuesday. If everybody gets the count papers going, go absolute. Take us out for
Yeah.
this Friday.
Yeah. So one more thing I think I remember about digital versus analog. Um, how I try to understand the distinction is that it just occurred to me the difference between the two camps is, and I think you and Richard suggested. So basically, there's a very discrete point of trade entry which marks the price series for you, for the discrete people. So there is time series before trade entry, which you kind of look at the price series and you look at that data and you study it, you analyze it, and you discern something from it. And then you, boom, you enter the trade. And then from that point on, price doesn't exist for you. It doesn't exist in terms of what it's actually doing. You only care about whether it's going to take you out by a stop loss or a trailing stop, and that's it. So the price data can do whatever it wants, and you're blind to it and you don't care. You're having the position on until you're being taken out. Whereas the analog people don't have such a discrete point in time. At no point in time there is a special point on the price series which marks that day when you enter. So for the analog people, every day, every data point is equally valid data point, just like anything else. And the history is equally valid as everything else, however long back you're looking at. So you're just going as time goes and the price creates new data for you. You just go with the market, with the time in present, and you analogically adjust your view and your position with that changing market. And this is how that can be reflected in probabilities or whatever. And the difference is also is that with the analog approach, at any moment in time, when let's say you start your strategy from zero, it's very easy with analog to just take a snapshot of the markets right now as they are today, and you know what your position will be today, and you put your positions on right now because you want to express your view, your relationship with the world through the price series and what they're telling you at any moment in time. And that's what your expression is, and that's what you're saying. Oh, the world looks this way. This is what I'm doing with the world. Tomorrow, the world looks certain other way. Oh, well, okay. Or the next week or the next month, as the world changes, I'm changing my relationship with the world, my bets, my positions with the world at all times. Whereas with the discrete time thing, again, there's this problem which you said, like with the crude, we went from 60 to 120 in 2 years. Now I want to join the strategy where crude after crude went from 60 to 120, and you're saying your expression with the world, because you entered the trade at 60, your relationship with the world is unchanged. You don't care what happened over the last 2 years. You only know that it's up a lot. You don't care how it went up. You have profits. This is your expression with the world, but your expression to the world, like you're betting with the world, your relationship with the world is very different from somebody who will be entering the strategy today. Because what you also said, hey, I want to join the strategy now. Shall I put the same crude position as you have now? You said, well, no, because you don't have open profits in it. I have open profits in it. I can play with them. You can't play with them. So for me, and for others, for the analog people, this discrepancy between how shall I say it? This conditional, so basically your view at the world today is conditional on an event that happened a long time ago. Is conditional on whether you entered crude at 62 years ago or you didn't. If you entered crude at 62 years ago, your relationship with the world should be X. And if you didn't enter crude at 62 years ago, your relationship to the world should be different. But you both have $1 million to put. You have $1 million now exposed to crude. This other guy has $1 million in cash. He wants to have relationship to the world. You're telling him, no, 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 no. Statistically, I have a different relationship with the world to you because I have open profits. And to me, this is contradictory. Because if you don't analogly adjust your relationship to the world on a day-to-day basis, you have to have conditional relationship to the world, conditioned on your certain discrete event that happened 6 months, a year, or some time ago. So this is the philosophical argument that I have. It's not a problem, but this is like a basic differentiation between the analog and the discrete people that multiple systems don't address.
The only thing I want to ask is, would I be considered a heretic? And if so, could I seek absolution if I were to buy on open a certain unnamed ETF coming online next week?
Well, wait for me to get done, and probably I don't think they're going to take your order until I come in. So I'm not sure how that's going to work. We're trying to figure it all out. The market maker does a trade on Monday, and then I come in Tuesday and take that from him. 9:30. I'm not sure what time it's going to be, but I don't know. I can't. I know they've been telling me, look, someone could
But
come
Jerry,
in.
what size redemptions could there be? Like how big of a block would you have to redeem ETF shares for whatever for the portfolio, or that won't be possible?
Oh, I'm not. I'm not following your question.
Oh, well, so basically, let's say I have $1 million in the ETF right now. Like I don't know how many shares, whatever, 10,000 shares or whatever they are. Is the only way for me to get out to sell them in the market, or can I sell them to the market maker or to the issuer for 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 the positions themselves, I guess, or I don't know. How is that going to work?
Yeah, I think the market maker is in there orderly, and so let's say you try to sell and there's no bids from anyone else. The market maker is there to always have a bid. The lead market maker. They're committed. There'll be many market makers, but only one lead market maker, and they have promised to always make a market.
Okay,
I
I
was
get
in
it. Okay,
Yeah,
yeah.
I was in there buying ETFs for Andrew's fund, DBMF. That's at 700 million now, and I put a order in. The bid offer was pretty tight, and oh, granted, he trades 14 markets, but it was pretty tight. And I just pushed buy, and then I was filled within a couple seconds. So I don't know. Hopefully, it depends on the ability for the market maker to hedge and to hedge the portfolio. We're making it very difficult for them, and this is why people have told us like this is going to be really hard for them to pull off. But they've told us that they can easily do it. So, but yeah, I mean, we're bringing futures and equities, 150 futures, 150 equities. And people are like, well, no one's ever done futures and equities before at the same time in the same fund. You can't do it. Well, not only that, we're doing 150 of each, and we're doing markets that are closed: Brazil, uh, South Africa, Malaysia. And so let's see. They say they can do it, and they say that they can give us a good bid offer. So we'll see. We'll see what happens. Oh, I don't think I have time to answer your first question or comment about this philosophical question. I lost my train of thought on that one too, but I do think. I remember someone saying once, I correct people when they say this because it sounded good. It was when I first started trading for Chesapeake, so 1988. One of I worked with the guys who were raising money for me. We had the same office. We worked together in the same office, and one of them, they would always critique my trades, and they would say like, you should never have a position on today that you wouldn't put on today. And I was like, oh, damn, that sounds correct. I mean, that sounds really correct. If you don't like the position today and you wouldn't do the trade today, let's say more specifically, if you wouldn't do the trade today, why would you have it on today? And I was like, that sounds like a good thing to say. I need to think. Rich didn't tell me that. I'm like, only thing I know is what Rich told me. He did not say that, and no one brought that up. And then recently, I heard someone say, "Well, the maybe they were starting a new account or whatever, and they said, well, I'm going to put this trade on because the system is long, and the system is telling me to put the trade on." And I think my answer to both of those is that that's not correct. The system is not telling you you should be long today. It's telling me you should have been long a long time ago at 60, right? That's what it's saying. Do the trade at 60. It's really a systematic trader type of a view. It's like I would not do that trade today. It's just fallen 3 ATRs in one day, and I'm a trend follower. Um, but I didn't do it today. I put a full position on 2 years ago at 60. I'm holding it with profits. My whole goal in life is to create in everything that I do, my trade level, my systems, my not doing fall management and correlation management. Everything I do and think of and everything I don't do has virtually one reason behind it, and that is follow these rules. And these rules are one entry, one exit, and a stop loss. And when I do this back test, the computer says, yeah, you'll make money. Sure, go ahead with these breakout systems. It's just going to be a low sharp and a lot of volatility. And so that's what I'm on this earth to do, is to put myself in a high likelihood of carrying out this one entry, this one exit, one stop loss method for all these 300 markets, long and short, every single day from my past life and my future life. That's all I'm here to do. And that's all we're ever saying about this stuff is it's peculiar to this systematic approach that worships sample size and robustness. And we first got to count it and be able to count it. And then we got to count enough of them, knowing full well that we got to put the entries and the stop loss exits in one bucket, the entry and trailing stop exits in another bucket. And this becomes very, very difficult. It's not just counting the trades or counting the days. And this is what we're worshiping, this sample size, this discreteness. And so, and it's way worse than Mark put it in this digital versus analog. Because, if I was arguing against myself, I would have called myself out. No, I don't know if anyone called me out, but I didn't, because it does get better to compete against analog if you have multiple digital systems. But some of my systems, they all get in on the same day. They all get out on the same day. So it's not really achieving what this analog type continuous system is. Probabilities increase and decrease. I'm adjusting positions. We just don't believe that, because it may work. Good luck with it working. But a lot of us are these very conservative accountant types who, if you give us a choice between doing things simpler and safer, we're going to choose it every single time and miss out on a lot of good stuff and fun stuff of life. But we're going to be able to sleep better. And I think in the long run, worst case scenario, we'll end up in about the same place as the more adventuresome type of traders. Oh yeah, another thing I was reading about this week. I'm always reading these articles and being jealous. 300 markets, 5 to 10% outliers, and these trades are so small, and the outlier could be 100 ATRs, but I'm embarrassed to say percentage-wise what it would be. It's so small. And then you compare that to these other more swashbuckling type, cowboy type trend followers. I'm sorry, hedge funds that just nail this macro strategy and make all of this money. We just nailed the bonds, and that's what all we had on for a year or two. And look how much money we made. Yeah, I really wish I was, I really wish they would write. They're not going to write a lot of articles about a guy who trades 300 markets and takes a healthy stop loss and loses 12 basis points. Yeah, that's not going to, and hopefully makes like 20%. No more. Don't want to do too much more than 20 because there will be that 40-some% drawdown. All right. That's enough. I'm going to end with a long monologue as well. It's been fun. Thanks everybody for being here, and have a good weekend. See you next week.